Ishtiaq, back again with us. We talk about everything, but there's a certain few questions few people do ask us.
Yeah. I'm guessing you're saying how to save tax, yeah?
I think
something along the lines.
You know when people say how to save tax, respectfully they're saying how do I not pay tax?
Yeah. How do I avoid the tax?
How do I avoid paying?
So,
But I think what people do ask is when we speak to certain investors, certain clients, Fayaz, I've got an accountant. He's advising me this, or I've got an accountant, but he doesn't know much about properties and stuff. Can you help me? The question we'd like to know is, being a chartered accountant, there's loads of fields you can go into.
Mm-hmm.
As we know, your speciality is property tax.
Yeah.
At what point did you realise this is what I want to go into? Because bear in mind, like us lot being in the property industry, there's different strategies you can use in property: Airbnb, service accommodation, supported living, rent to rents.
Of course,
but we know our speciality is social housing, supported living, and sourcing.
Yeah.
People don't understand it's a vast. If you say property, it's a vast topic, same as accountancies.
Of course, yeah.
Was it something that you started off like, this is the field I want to go into, or was it most of your clients that you had, as well as having businesses, also had side income as properties?
I think what happened is over time, when you start doing accounts and looking at people's paperwork and records, you get to see how beneficial having and holding property is. For example, you might have bought something 20 years ago, put a deposit of £10,000 to buy a property, and that £10,000 is returned to you within a year or two.
Yep.
After that, the deposit is being paid back, and it's continual profit: 10,000 in year 1, 15,000 in year 5, 20,000 in year 20, for example. So what I'm trying to say is, you need to look at the relativity of the returns that you're getting on your investment. Today, for example, I've got a flat which is returning me, say, £1,200 a month. 10 years ago, it was getting me £500 a month. So sometimes
properties
you look at
mature.
the future value of rents rather than does it look good today, for example. So and the general trend for property prices and rental income has been just exponential in terms of returns and also appreciation as well.
Especially in the last few years.
The last few years as well. But if we're looking at just the last few years, imagine from the last 30 or 40 years, you could probably buy a property for, a couple of £1,000s 40 years ago or 30 years ago. It just continuously goes up. So what I'm trying to say is, if you've, again, I'm not a pension advisor or qualified to do so, but sometimes I'll see pensions that people have put into for 30 years, and the contributions have been £30,000. After 30 years, it's worth £42,000, which is not much of an increase. Whereas if you put a deposit for a house, like we were talking about earlier on, let's say you put £10,000 in 10 years ago, the property was worth £100,000 at the time. Now that £10,000 property deposit is holding a property that's worth £320,000. So your £10,000 actually made you, £310,000 in appreciation, and the return on the investment that's been giving you every single year.
Scrap your pensions, guys, is what he's saying.
Well, I'm not saying that, but you need to think about it, that's all.
Yeah. Again, opportunity cost. There's 30 grand that could have been, like you say, in a property 20 years ago, 30 years ago.
It goes back to, we keep saying hindsight.
Yeah,
we won't talk about hindsight. So, couple of things I want to know, because I've just purchased a property, and obviously being self-employed, getting a mortgage is the biggest pain.
It's a nightmare, isn't it? Yeah, absolute nightmare.
Oh, God.
Usually, is it in a company you've bought it?
No, I've bought this one in my personal name,
Okay.
because there's a value uplift on it. And again, I plan on possibly being able to sell this within a couple of years.
Oh, fantastic, yeah,
so
good.
What I want to know is, as a self-employed or a limited company director, how could you streamline your taxes or yourself to be more appealing for a lender? Is there a way I could have made myself look more attractive to the bank, rather than them auditing me three times before I got my offer in?
I think in my last podcast I mentioned I'm also a qualified mortgage broker as well. Right. So I've done the CMAP exams, and it was literally just to understand what the criteria underwriters and lenders require when we provide documents for clients to them, and just to make sure that we understand the processes and the systems, and sort of to make it easier for the client to get the mortgage, in a nutshell. So one of the things is they'll usually ask for 2 years minimum in terms of records or tax returns on your personal name. And of course, the income, it depends if it's a buy-to-let property or a residential property. Again, there's different criteria. Your credit rating must be good. You must have, no defaults, anything like that. At the same time, lenders will look at the return on the investment if it's a buy-to-let property, and subject to the returns that you're likely to get alongside your credit rating and possibly the level of income that you're on as well, give you a mortgage. Simple as that. It's different to a residential property. In a residential, they will not look at the return on the property as though you're renting it out, but just on whether affordability-wise you can cover it. Simple as that. Usually 4 to 4.5 times your income on your tax returns or on your P60. Again, having a clean credit file. If your credit file isn't perfect, you might get subprime lenders which will give you mortgages, but I don't generally try to stay clear of those.
So we had a decision in principle, or a mortgage in principle, whatever you want to call it, between me and my partner in excess of £200,000.
Okay.
I've bought a property for £121,000. So well within my affordability range. I got looked into 3 times.
Yeah.
Where they've opened the case with the mortgage advisor and put it under, scrutiny basically to check that we can afford it. At one point, they even came back to us and said, we would ideally like to just give you a price on what Miss Savage can do. And I was like, I've got 3 years accounts. I've paid all of my taxes.
Yeah.
I've never defaulted a payment. My credit score is about 789 out of 999, which is really good.
Yeah.
On paper, I should be the ideal candidate, but just because it says self-employed on there.
I've seen that, I think if you're employed, like I'm giving you an example, if you're a teacher working for the NHS, it just seems more... less of a risk profile for the lenders. So usually when I see cases where somebody's working for an employer over a period of time, it's a lot easier to get the mortgage than in your scenario where you're self-employed.
That's why they wanted to lend to her. She's been in a job for 8 years, so they obviously saw her and just thought, I'd rather give it to her instead. But wasn't quite feasible on her salary to cover the full amount, so it would have left us with a shortfall, a gap to make up, which I didn't want to put it in the property. There's no point it being sat there. So
no, agreed.
So if there's anything in particular, any tips for your tax or just anything in general that you think would benefit people in the long term, from mortgages or a tax standpoint, then...
So again, are we referring to buy-to-let properties or residential properties?
I think we can touch on both, because I think it's a time where we've got investors that do buy-to-let, but at the same time, we've also got people like myself as included and him who are both self-employed, who are both looking for own residential properties.
So just for normal residential, usually you want to have 2 or 3 years. They look at, it depends on lender to lender. Personally, I would use a good broker and pay the fee that they ask you, because they might ask you, I don't know, the going rate is maybe £500 or £600, because they've got access to the whole of the market. If you go walk into NatWest Bank or Halifax Bank, they're only going to give you their own products, which might not be suited to your retrospective scenario. So if you go to a good broker, they will search the whole market and find the best product for you. And that's genuinely, and it's worth paying that amount to a broker to do that extra work to search the market, number one. Number two, of course, make sure if you've got any issues with your credit file, they're all corrected, and you can get them corrected, and make sure your file is clean. Number three, make sure you've got the deposit in place, because that will help as well to say, look, we've got savings of £60,000. It's sat in this bank account. You'll have to provide that to the lender as well. And really, that's about it, just to make sure everything ticks in terms of the the criteria of what a lender would want. Flipping this onto the other side, for buy-to-let side, again here, when you buy the property, you need to make sure that it's mortgageable. So some properties that might look fantastic on paper, but the condition is in such a state that the mortgage lenders might not give you a mortgage on that product, on that property rather. Also, you need to look at the returns that you're likely to get in terms of rental income on that property. That's something else the lender will look at. It's not as much your income that they look at. It's more possibly the return that the property is going to give you in terms of facilitating the repayment of the mortgage, in a nutshell.
Yeah. So we, I was speaking to someone. She's called Kath.
Mm-hmm.
You know, I don't think she's going to be watching, so I don't think she'll mind us speaking about her. She was in the process of buying a property. This property was in Leeds somewhere.
Mm-hmm.
She was purchasing it for £200,000. It was going to return 4.5% gross. And she was saying she was struggling to get a mortgage on it. So I broke it down for her and I just says, if you're going to buy something at 200 grand and return 4.5%, and she says she was doing it for capital for appreciation.
Yeah.
And then I broke it down to her. I says, on a buy-to-let mortgage, I can go get you 3 properties in Bradford, just as an example, that would rent out for £900 each, and you're buying a £200,000 house that rents out for £900.
Yeah.
So you can have the same money down and triple the amount of income from it.
Of course, yeah.
But she was just completely tunnel vision on.
Yeah,
appreciation.
sometimes I see this as well. I think emotions come into it.
Yes.
People think that, look, I want to live in this property because I like the property.
So it'd be a
It's a
perfect
trophy
house.
asset in a certain
Yeah,
area.
whereas I've got properties in areas that I wouldn't personally live in, but
Wouldn't even
they've
live
never
in the
been
area,
empty.
never mind the house.
You know, for the last
Yeah.
10, 15 years, they've actually never been empty. But I wouldn't live there, but there's plenty of other people that would live there. So a piece of advice would be to not get emotional about the property that you're buying.
It's a business.
But rather to think of it as a business.
100%.
You know, you might not want to live in one street, but there's 50 other people that might want to live there. So if you are going into property, don't get emotional about a street that you might have lived in, an area that you might have grown up in.
Childhood houses. And
Yeah, you just think business rather than in a personal manner in relation to buying properties. Yeah. Just
Yeah.
going back to your question earlier on about tax tips, we'll just touch on that because I don't think we've got a huge amount of time left, have we?
Not massively, no,
No.
because we've got someone else coming
Someone
in.
else coming in,
afterwards.
yeah. So you were saying, look, we were talking prior to the meeting, you were talking about companies. You're setting up a limited company to buy several properties, I think you mentioned. The tax rate for companies, corporation tax, below £50,000 profits is 19%, and then it goes upwards 25% thereafter on a marginal relief rate, okay? You could get a company car through your business.
So I was
Yeah.
actually going to speak to you about this
Yeah.
out of the podcast.
Yeah.
So I know that unless this price per mile comes in and they start charging you electric cars for your
Yeah.
distance, it's 120% tax write-off, is it? Or 110%?
So if it's a new car, an electric car, for example, it's 100% write-off. So if you spend £40,000 on a car, I'm just giving you an example, the whole 40,000 comes off your profits for corporation tax. Simple as that. So if you had rental income profits after the expenses, after the mortgage, and the profits were £40,000, you'd pay circa £8,000 in tax. If you bought a car for £40,000, put that into the company, electric car, you'd be paying almost zero in tax. So you're saving that amount. If it was a £100,000 car that you bought, as an example, you can actually carry forward losses to the next trading year. Okay. So you'd still have 60,000 that you can carry forward to the next tax year.
So the only thing that concerns me about this, and again, I assume
I know your
you
question.
probably
I know what
write
you're
it
going
off
to
as
say. You're going
an
to say
expense.
that
the
electric car,
depreciation on
yeah,
these
the
cars
electric
now.
cars. You buy a new electric car, it's costing you £100,000.
And it's
Let's say a
immediately
Porsche
worth
Taycan. A year later, it's worth 40,000. So my advice to everyone is actually don't buy a new car, and that's what you read on the internet. You know, new car, you get 100% allowances. If you buy a used electric car, let's say you bought that Porsche Taycan you were talking about
At
for
40 instead of 100.
£40,000,
It's
you
still
can
going down,
write
by
it
the
off
way.
at 18% every year, for example.
Right.
So again, you get to claim, write it all off, but it takes 4 or 5 years, 6 years, 5 to 6 years to write off the 40,000. But you've actually still claimed the the capital allowances, and at the same time, you've saved 60,000 on not buying a new car but a used car. So get a used car, buy a 1-year-old car.
It's not fairly old either, to be fair. 1 year old.
You still be under warranty.
Yep.
To go for 1-year-old, you're saving 50% or whatever it is. Somebody else has taken that depreciation, so you're buying it at a price where it's, let's say, half the price, and you're still claiming the full 50,000 as an expense over a period of time, instead of claiming it in 1 year. Make sense?
Yeah, no, it does. And if you were to lease something,
Yeah, exactly the same.
Exactly
again.
the same.
Yeah, but the lease, like I said, leasing, the payments would be considered an expense. You might have some benefit in kind to pay. Usually on electric cars is 1 to 2%. But lately, the new mild hybrids are actually very good as well. So if you look at the new X5 or the Volvo T8,
yeah, I was just going to say,
yeah, they're absolutely fantastic because the benefit in kind is only 8%. So for a lower rate taxpayer, you might get away with paying circa £100 a month in benefit in kind, but you've got a hybrid car, which is, of course, either diesel and petrol and electric, and it might be nicer to drive. Some people just don't like electric. So the new mild hybrids are worth looking at. Some of the new Volvos, some of the new BMWs. Like I said, the benefit in kind is only 8%, which is very, very little.
And benefit in kind for a layman is?
The tax that you pay on the use of that car from a limited company.
Right, okay.
So any car that you get provided by, even if it's your own limited company, you have to pay a tax on that. And the lower the rating, the benefit in kind figure, the less the tax you pay.
Right,
Simple as that.
So
if you bought a Range Rover, let's say a big engined, 4-litre, 5-litre Range Rover, the benefit in kind might be 35-40% on the value of the car. So if it's a £200,000 car, 35% of that is 70,000,
Yes.
and then you pay the tax rate of your retrospective income tax rate. If it's 40%, you'd pay 40% of £70,000 in tax at the end of the year because you've got a big heavy car. But like I was telling you, some of the newer mild hybrids, there might be £50,000. The benefit in kind is 8% of that, and then you pay tax of 20% or 40% on the 8% value.
where does it tell you this information?
Just go online. There's a government car tax calculator.
Right.
Just straight onto Google. The other thing I was saying was the payments that you make for the lease payments or the monthly payments for lease, that comes off against your corporation tax.
Right.
So it's a saving.
So they've Mo has just given one of his cars back. His lease has expired. He's taken a new lease.
Yeah.
Car was in, regular condition as you would expect.
Yeah. Yeah.
They've left him £9,000 in negative equity.
So that wouldn't have been a lease. It would have been some kind of PCP or hire purchase or something.
No,
along those
it was
lines.
just it was a lease. Pay your fee every month. Any issues, they'll take it back and repair it. At the
I'm
end
not
of your
sure
2
why
years.
he's having to top up on that, but we can talk about that later.
So what they've done is they've come in. He's scuffed a wheel. They wanted 900 quid
okay.
on a scuffed
Okay.
wheel and
yeah.
bits and bats. They've eventually we've had this discussion with them. They've got that £9,000 bill down to less than 1,200 quid.
Right.
So Mercedes have just been rather.
Yeah. Well,
But at the end of the day, it's 1,200 quid that he's now in negative. Is that a claimable expense as well?
I have to check that, but I think it probably would be.
Right,
Yeah, it'll be an
okay.
expense. It's a company expense at the end of the day, and the car was used for the company. Simple
Yep.
as that.
Right.
Yeah.
Okay.
Going
Ishtiaq.
back to your other tax saving tips we can look at is, for example, it might be worth, again, if it's a property business, and we were discussing this bit previously, adding on whoever's involved in the property onto the payroll of the company. So you'll save tax by utilising or paying them wages.
Shareholders.
Yeah, you can split the
Dividends.
shareholding. So you've got dividend allowances. I think now it's only come down to £1,000
Yes.
tax-free. So if you've got 5 shareholders, that's 5 lots of 1,000 that you can take out tax-free, for example, as well. And 5 lots of lower tax banding, up to £52,700, for the dividends to be 8.75% when you take them out. If you just got one shareholder and you want to take out 100,000, after 52,700, you're paying 38.75% tax. There's two shareholders, you've got two lots of 50,000, 52,700 at 8.75%. So it's good to have more shareholders.
It's just people don't want to part with anybody these days.
Yeah, can you trust the people that
They
you're
pay you.
partnering with? Is half of
Other things that are good to have is things like a relevant life policy. I don't know if you've come across that. So this is something you can set up through your limited company, which is like a life policy, but the company pays the premium. The payments are an expense against corporation tax.
Okay.
And at the same time, it assures you or your family, let's say hypothetically £500,000, if something happens to you. So that can be used to pay off inheritance tax. It can be used to pay off mortgage amounts. It can be used to give to the kids when they turn 21. You stipulate the conditions that you want that life policy to have. And should anything happen to you, the premiums are actually held in trust as well. So in terms of inheritance tax, it doesn't form part of your estate. And the payments that you make for that life policy are an expense against your corporation tax.
And what about private healthcare or dental care? Things
Again,
like that?
you can put that through your company as well, but
Because
you would
I know
have to
certain
pay
companies
benefit in
do.
kind on the
Right.
actual benefit that you received from the limited company. But yeah, it's not a bad idea. It'll
So
reduce
you'd
your
pay a
corporation
tax on the amount. What do you
of
mean?
benefit that you've received.
Benefit as
So
in
it might cost the company £1,000 a month. I'm just giving you an example. You would pay tax on the value of the benefit that you received from the company. It'd still be a lot less.
Right, yeah.
It'd still be a
Right,
lot
okay.
less.
Understood.
Ishtiaq, thank you for coming again. I'm just conscious of the time as well.
Oh, that's
So,
fine.
Thank you very much, guys.
Wonderful. Thank you so much. Thank you
You're
for
welcome.
inviting me.
Hopefully, see you again in a few months' time when all these rules come into play again. We'll recap again.
Yeah.
Absolutely, yeah. No, wonderful. Thank you for calling me.
Thank you very much,
guys.
Thank you very
Pleasure.
much.
Thank you.